Use code JACK250 to get $250 off to the Blockworks Digital Asset Summit. It's in New York in September, and ticket prices are only going up. Link is in the description. Over the past quarter, a spate of insolvencies has rocked the crypto world to its core. And yet, amid this run on the bank list, my guest today claims that his firm, an uncollateralized blockchain lending platform, has never had a single default on any of its loans. Naturally, I had a lot of questions. Please enjoy my conversation with Bill Wolfe. I am joined by Bill Wolfe, Chief Investment Officer of TrustToken. Bill, great to have you on Forward Guidance.
Thrilled to be here, Jack. Thanks for having me.
Yeah, Bill, you have a traditional background in finance. You're very into financial history, but you're now the Chief Investment Officer of a digital asset firm. Tell us a little bit about your journey. How did you get into the blockchain?
Sure. Well, as you say, my background is traditional finance, and I was an investment banker for 20 years. And then I went on a different traditional route, working with some partners to found a specialty aviation finance leasing business. But really, my journey that led me to blockchain and in the crypto space was really some FOMO I had from back in the 1990s when I was observing the development of the internet and saw how powerful that was. And I had the opportunity and an inkling I should have gotten involved, but I didn't. And I don't have any regrets in my career, but I think I'm now making good on something I wish I had done a long time ago, which is get involved in an emerging and cutting edge technology.
And how did you first hear about blockchain? How did you get into it? And how have you evolved since you first started hearing about blockchain? And how has the space evolved?
I heard about Bitcoin and other related things around crypto and blockchain fairly early on. And frankly, I didn't pay any attention to it, and I frankly didn't understand it. And then a group of guys that I spend time with here in Silicon Valley and do a little bit of fun investing with brought to our attention the company that I'm now a member of, but initially as an investment. And we looked at it, and a bunch of us all invested in it together. And then I realized that it was a traditional finance play, and I could, or at least it was an emerging markets take on a traditional finance play, and that I could add some value. So I invested and then became an advisor. And then during the time while I was advising the company, TrustToken, it became time for us to exit the business that I was currently working in, which is our leasing business. And I started thinking about what I wanted to do next. And I realized this was my opportunity to go back to the cutting edge that I missed out on 25, 30 years ago. And so that's what brought me to it. And it's been the most exciting thing I've done in my career. And I'm thrilled to scratch that entrepreneurial itch that I've had all along.
So, Bill, why blockchain?
Well, so Jack, once I started digging into it, and I don't think I'm unique, a lot of people go down the rabbit hole and they start investigating it and they realize there's so much interesting about it. And as you mentioned at the outset, I am a student of financial history and a little bit of a geek in that regard. And as I got deeper into it, I realized that this wasn't just an interesting add-on evolutionary technology. I believe, and a lot of people believe, this isn't, I'm far from alone in this, that this is one of the most important evolutions in technology that's going to impact finance. And in my judgment of this may be one of the top 5 major innovations that have ever happened in finance. And including in that are such fundamental things that we take for granted that are centuries old, like dual entry accounting, like central banking, like fractional reserve banking. And so just like in the 90s, when I missed the opportunity on the internet, and a lot of smart people realized that it was inevitable that the internet was going to be a very productive and interesting place to move information, to conduct commerce, et cetera. I believe, our company believes, and obviously thousands of other people believe that that blockchain and Web3 is going to be inevitable to be a fundamentally important and revolutionary, not evolutionary technology for finance.
Right. And Bill, obviously I suspect that you believe that blockchain in many different applications of finance will lead the way. But what aspect of finance do you think is blockchain most applicable, where it will cause the most disruption? Because, let's say, you're a student of finance, financial history. So, money, there's the medium of exchange, there's the store of value, there's the unit of account, there's investment banking, there's debt, there's equity. I suppose, when Satoshi Nakamoto wrote the white paper, they were trying to solve the double spending problem. A lot of people who are very into Bitcoin now, they're more interested in perhaps the store of value. where is the biggest opportunity for blockchain, let's say in the next 3 to 5 years, where you just think, finance will not be the same because of blockchain?
Well, I think there's a lot of them, and probably there's more than we have time for in our chat to talk about. I'm going to focus on the one that I think is most interesting. I'll start at sort of the higher level, which is the disintermediation of trusted institutions, where you no longer have to have fabulous 100, 200-year-old institutions, or maybe just 50-year-old institutions that are the embodiment of why you trust and why you are willing to transact with and trust your financial future, whether you're an individual or a corporation or an institution. I think that's the most fundamental shift in what's going to happen. So let me take that down a layer. And the area that I'm most focused on and what our company is focused on is in debt and in credit. Because right now, the problem that we're working on and that we're trying to address is the overall corporate credit markets. And there's a bunch of different ways to measure it. But the way we look at it, and the measure we think is most interesting, is today around a $7 trillion market for corporate credit. A lot of people in the early stages of DeFi or decentralized finance that's going on the blockchain in the crypto world first focused on collateralized or over collateralized lending in that space. But that's a relatively small part of the traditional finance world in that $7 trillion market number that I mentioned. Margin lending, effectively, which is what that is, or collateralized lending of securities, is a relatively small part. So we're going after traditional credit-oriented space. I think that's going to be, and it's not going to be necessarily overnight. It's not the next 12 to 24 months. I think this is a 3 to 5 years, rapid change. And then over time, just like the internet took 20 years or so to get to the stage that it's at today of rapid evolution, I believe in 10 to 20 years, you will not recognize the way finance works. And that's not just our opinion. Major financial institutions, while they may be giving different signals to the public about it, they're spending lots and lots of money, millions of dollars in development to look at how they can future-proof their businesses from the evolution and the disintermediation that's possible in Web3.
I want to highlight that distinction that you drew. So in the traditional finance world, credit is used by companies to do real things, to build a factory or refinance other debt. That is separate from margin lending, where a trader, I want to short this stock and I want to get extra juice and go extra long on this stock. That is a fraction of the entire TradFi credit markets. Whereas in crypto, it's my perception, at least, that the vast majority of crypto lending right now is about financial flows. And it's my perception that the real world lending for blockchain, which when people hear this, it may take them a second to get it because they didn't know it existed. I didn't really know it existed before I spoke to you, is a small fraction. So roughly how big is the crypto DeFi and CeFi lending market for finance? And then how big is the real asset blockchain market?
Great question. So the market that developed first is the one you're pointing to, which is the on-chain lending markets. There's the collateralized portion, which I'm not going to speak to, and these are these fabulous algorithmic protocols for borrowing and lending on a secured and over-collateralized basis, like Aave and Compound. And that's a big business. It continues to be a big business. It's tens of billions of dollars. It shrunk a little bit just because the underlying assets that people were borrowing against has shrunk.
Right.
What we started out testing our technology on, and is still an important business to us, is lending on an uncollateralized basis, on a credit and reputation basis, if you will, to market makers and delta neutral hedge funds in the crypto space. And we did that because it was a market that no one had addressed yet. And it was a chance for us to apply a traditional credit approach to this new market. Now, that market got to be fairly sizable. It turned into a many billions of dollar market. That has shrunk also with the downturn that's occurred in the crypto markets, just because the demand for capital and also the uncertainty about who's really deploying that capital in a productive way, in a way that's not too terribly risky, has decreased that a little bit. Much smaller and much more emergent is what you're referring to. And this is where we think the important development is going to be, which is lending against real economic opportunities. So not just the self-referential internal crypto system, which doesn't necessarily generate any real GDP, to your example of financing a factory. And so right now, that real GDP loans or real asset loans it's just low millions right now. We believe that's where the incredible evolution is going to happen. But it's one where lots of pieces and and building blocks, if you will, have to be put in place for it to happen. And so we're working on some of those building blocks, both at the TrueFi level, that's our protocol, which is governed by our utility token, True, TRU. We're building a base layer of software using smart contracts and blockchain programming to allow people to come and invest or lend money, have portfolio managers come and form portfolios, and then have borrowers who are looking for capital come and utilize that capital. So that's our base layer, and we're building that as one of the building blocks. We're also building on our corporate side, on TrustToken side, we're building additional software and services that sit on top of the protocol layer software to give additional functionality to those portfolio managers, to those lenders and investors, and to those borrowers. And so right now, that's a very small effort, and a lot of things have to be built. But our analogy we think about is, we're at early, Web 1.0 days, and the business models and the innovations that need to happen to take us into the Web 2.0 equivalent world, which is now obviously we're talking about Web 3.0. Those things are being built. There's lots of folks doing what we're trying to do or doing pieces of what we're trying to do. And that composability and that innovation is going to be dramatic over the next several years. This downturn that's happened in the marketplace, while it's not ideal, in some ways it's analogous to the dot-com bust that happened, where a lot of people created business models that weren't really productive. They weren't really contributing anything. They were riding the hype. So a lot of that, what I call the underbrush, is being cleared out right now. And the folks that are really trying to build something that is transformational and hard, quite frankly, is going on right now. So it's very small right now, but we believe that 5-10 years down the line, in the same way that the inevitability of the internet slowly started building, and so that e-commerce is huge today, we take it for granted. We believe that in finance and in lending, the sector that we chose to focus on, that it will be huge and meaningful, and that will be a much more efficient way for people to form, manage, and deploy capital.
Right. I guess the idea is, if you're lending on the via the blockchain for real GDP loans, lending to companies to make factories, in theory, intrinsically, it will not be correlated to the price of crypto. Whereas if you're making a loan against Bitcoin and the price of Bitcoin falls, you've got to liquidate your obligor, otherwise you'll be in some trouble. Of course, you are, I guess, dependent upon the capital to lend, and if there's inflows or outflows, and if there are a lot of outflows during a market rout, that can be destabilizing. But yeah, is TrueFi lending or TrustToken lending its own money? Is it pooling investors' funds to lend to those businesses? And also, what sort of businesses are borrowing real GDP loans via your protocol?
Great question. So no, it's not our capital. I mean, we do a little bit of dog fooding. We do have some of our own corporate capital, and we have at times deployed that into some of the strategies that are being managed on the protocol. No, the investment are coming from investors, and these are the early adopters. These are folks that are already crypto native investors. They've made money in other areas of crypto, and they've decided this is a place they want to stay on chain, if you will, and they want to find a yield. And initially, they were investing into our funds and our portfolios that were lending into the market-making function, because they understood that, and they understood what that risk was. And we've had a fantastic track record in managing that. It's not perfect. There's no such thing as lending without some bumps in the road, but it's not like some of these CeFi lenders, if you will, that were lending into the blockchain and not doing it in a highly visible, transparent way. And they made some very poor choices. But the money is mostly coming from crypto native investors. We have some initial investors coming in who are not crypto native. And this is part of the building block point, which is we're having to help them with on-ramps to come onto the blockchain to seek yield, because traditionally they would go into just normal digital approaches, where they would go to pick your favorite mutual fund complex or your favorite alternative credit manager, and they would, maybe there'd be a digital component to it, but it'd be a more traditional investment on-ramping. So back to your point about what are some of the real opportunities that we're currently doing that with these lenders and investors that are showing up on our platform. One of the best examples I can give you is in the fintech space. And that's an area that we think is an opportunity for us to address in terms of credit markets, because there's a very well-developed mainstream corporate alternative credit market, meaning not the banks lending, not traditional capital markets lending and bond market activity, but the tradition this alternative credit market. And then there's traditional venture capital and venture debt. Well, there's some holes in there for some of these newer business models that are not well served by those traditional sources. We've identified some of those. It's not that those are risk-free, but they're interesting areas and they're real GDP lending areas. And one of the examples that we're doing right now in an area that we have to do a lot more of is we're lending to a payments and small to medium enterprise lending business in Mexico. And one of our portfolios lends to this business in Mexico. They take stable coin dollars, which are these are digital assets that are represented by dollars in bank accounts. So they're stable. They're not going to go up and down because people know they can take them and exchange them for a dollar at any time. We lend those to this fintech business in Mexico. They convert those into pesos, and they are making money by providing a service that's not well served by the banks in Mexico, which is for this small to medium enterprise emerging customer to help them with payments and to lend them money on a very short-term working capital basis. So that's just an initial example of that. We're doing some other experiments out there. We've launched a new fund which is available to lend into real estate in the Austin, Texas market. It's not traditional mortgage lending like you would see because that's working very efficiently off chain. And over time, we think this is going to become more and more important as managers come on and demonstrate they can run a differentiated credit strategy on the blockchain, do it in a highly visible, transparent way, do it in a 24/7, 365 a day transacting window. They don't close on at 5 o'clock Eastern time, and they don't close on the weekends, and they're open on holidays. And so that plus the transparency plus the efficiency of this overall system that the blockchain provides for transferring money, for knowing where your money is, and being able to transact real time. All those advantages we think are going to accrue and make this into initially a tens of millions business, then hundreds, and then again on that 5 to 10 year business, a billions and tens of billions business.
Right. So when you're lending stable coins, which stable coins are you lending, and what are those stable coins backed by?
Great question. So, and this is an area where a lot of people who've studied this space know there's many different forms of stable coins. A lot of them get to claim the word stable, even if they aren't necessarily the most stable version of stable. The ones that we accept are true dollar or fiat currency backed. They can be in currencies other than the US dollar, but the principal ones are in US dollars. And so our founding funds that we created, our founding pools as we call them, accept 4 major stable coins. USDC, which is the stablecoin founded by our friends at Circle and Coinbase. USDT, which is the Tether stablecoin, which is very popular, particularly in some international markets like Asia. TUSD, which is actually a stablecoin that we founded, our company, before we got into the lending protocol business. We created the first institutional grade stablecoin by working with banks for them to, in the U.S., accept and for us to do real-time attestation so someone knows there are dollars in a bank account in case they want to exchange it out. And then we also accept Binance's stablecoin, BUSD. And so those are all ones that are all fiat-backed and very stable, truly stable coins. So people come and deposit those into the accounts, and then that's from there where we accept those. We're experimenting with accepting some other types of currencies. We think the major part of this is going to be these stable coins, and eventually we think the U.S. Treasury and the Federal Reserve are studying stable coins, and eventually we think there will be a U.S. central bank issued stable coin, but that's probably years down the road. And while they're working on it, these other ones are filling that important building block component in the marketplace.
Just walk us through the stablecoin ecosystem. I often hear it categorized into 3 categories: algorithmic, partially backed, and then fully backed. I would perhaps also draw another dividing line in the last category between fully backed and audited, which I think USDC is audited. I don't think Tether is audited. I don't know about Binance Coin. So yeah, in those 4 categories, where do you see the opportunities and risks?
Well, I think we've seen the risks in the pure algorithmic ones. And obviously, you're pointing to the Terra and Luna blow up that happened earlier this year. That was a absolutely fascinating idea and concept. It appears that it got exploited and attacked. and it collapsed. It was an interesting idea. I'm not saying that those ideas aren't going to continue to thrive. There are others out there that are attempting to do that. That sort of a method, but that obviously presented with extreme risks. And so we're not as focused on that. And like a lot of other people, we're very cautiously watching what happens in that. So that's in the pure algorithmic. In the partially backed, and this is, again, another area where there's lots and lots of players in this, but I'll mention one that we have a lot of relations to, which is MakerDAO, which is a reserve currency. You call it the partially backed sort of stablecoin. This is where people are trying to generate an alternative reserve currency where they issue their stablecoin, if you will, in return for people exchanging real world assets with them. Those could be loans. It could be a lot of things. And that's, again, an intermediate case here, which we think is also very interesting. And MakerDAO, the organization, if you will, behind the creation of MakerDAI, has been very, very successful. And we think that's an area that's going to be very productive and interesting. But the area that's for us right now, just sort of our bedrock and that we're focused on is the third area that you mentioned and the one I was talking about before, which is these purely fiat backed in a bank account somewhere. And you talked about how there's different flavors of this. Certain ones have different levels of transparency. What we created, and our friends at Circle with their USDC have a similar methodology. This is full transparency on this. And ours even goes to a different layer on that. We have an accounting firm, a major U.S. accounting firm that has the ability through API connections into the trust accounts where the dollars are deposited to see on a frequent and real-time basis exactly how many dollars are in there. And they then publish and attest to how many dollars are in there, which then gives the investor or the holder, if you will, of that stablecoin the knowledge that a trustworthy third-party source has said there are dollars there. You know your stablecoin is worth $1 because at any time you can go through the reverse minting process and turn in your stablecoin and back into your bank account through wire transfer or ACH or however the transfer occurs, you'll have a good old US dollar back in there. And so we think that's the most important one right now. And again, the enabler of this, because once you're in that stablecoin, your transactability is real time and you're avoiding the working pretty well, but far from perfect traditional system of finance, which relies on ACH transfers or wire transfers, which again is frankly programming and computer infrastructure that was built decades ago and that is very, very imperfect. A lot of people are trying to improve that, and maybe there's a way to bubble gum and rubber band that system to be as good and as perfect as the new system. But a lot of other people are making the bet, as we are, that the future is in the blockchain technology, which is, again, also very difficult to work with, not perfect if you don't program it well and test it well. So a lot of these attacks and loss of funds that you see happening is not because the technology promise is not good, and it's not that people have underestimated how good the technology could be. They've underestimated how difficult it is to work in this programming, because this is very, very complicated, difficult programming. But programmed correctly, it is 100% secure, and people are protected against a loss. And so that's what we think is going to be the important sector to focus on, and where we're really focused in terms of creating funds where people are able to use those stable coins as their method of deploying their capital.
Right. And then what are your views about those stablecoins that are fully backed, but they haven't done an audit? Tether comes to mind, where they give an attestation, but I don't think they've given an audit in quite some time. And in their assets that they hold, a lot of it is treasuries. Then some of it is loans. Some of it is digital assets. So it's kind of correlated, where when the prices go up, the value of their assets goes up, but when prices go down, the value of their assets go down. And I actually think that they did, lend they did have an asset that was in some way tied to Celsius, which I think recently declared bankruptcy. So yeah, what do you think about Tether?
I think this is a caveat emptor situation to your point and to your question, which is you're taking risk there. And remember, the risk you're taking is that when you want your capital, there's not a mismatch between your desire to have it today or right now and when the assets that have been invested in with the dollars that you put in there are available. And so I think as long as the individual who's making the choice of which stablecoin they want to use understands it, then they know what risk they're taking. But remember, they're not getting paid for that risk, because the interest being earned on those stablecoins is being accrued to the operator of that stablecoin. And so if you're not getting paid for that risk, my question is why would you take it? This is a personal preference thing, and I'm not going to disparage anyone else's choices. People are making that. Obviously, Tether is it's still today the largest in terms of dollars out there in terms of the minted Tether coins. It's still the largest one in the world. But you've seen over time ones that are fully backed and also in ones that are in much more liquid assets and not taking risk by investing in some of these higher yielding strategies are out there. One of the things we're crying for is more clarity from the regulators. Don't go so fast that you create, the wrong rules, but please go as fast as y'all can, because, we, like a lot of the other players, we want to follow the rules. But from our standpoint, obviously, philosophically, we believe that that the safest place to be and the best place for an investor is in these fully 100% backed, and that's what TUSD is, which is the stablecoin that we operate and that we created, and USDC is similar to that. USDC has been gaining ground because of the great distribution they get through Coinbase. They've been gaining ground on Tether steadily, and I think a lot of people are predicting that they will overtake Tether at some point in terms of total dollars minted, if you will, in stablecoin.
Right. Thanks for Bill. I appreciate you sharing your views on that. Let's move back to your company. It can be a little bit complicated, even if you are aware of the terminology. So TrustToken is the company, TrueFi is the protocol, TUSD is the stablecoin that you guys issued, but TrueToken is the governance utility token, but then also you're a DAO. So explain what's going on here.
And it is complicated. And I think you laid it out very well. But let's focus on the TrueFi side of it, because that is the base layer of what we're focused on. We started with our stablecoin. We're glad we created it. It's got, over $1 billion of minted coins out there, and it's an important player in the market, and we're proud of that. We accept other stablecoins, but what we're really focused on is growing TrueFi as a marketplace. And what we're trying to do there is create a place that is totally agnostic. It's an open marketplace where an investor can come and find a huge range of potential investment opportunities in terms of credit and in terms of looking for yield to invest their dollars. So we think of it as a three-sided marketplace. Investors or lenders show up looking for yield. Portfolio managers can come and use our software by literally pushing just a few buttons and making decisions and be onboarded onto the protocol. And say, I'm an expert in this particular type of credit management. And so here's my fund and here's what I'm doing and here's my disclosure around that. Deposit your stablecoins if you're looking for yield. And then where borrowers who are looking for capital can come and find from any different manager who's expert at deploying capital into whatever space they're looking for capital themselves to consume, can come and look for that. So that's the marketplace. What True is the utility and governance token that runs our marketplace. And what it's entitled to economically is that when people run a portfolio on the TrueFi marketplace, they pay a protocol fee. Now, we have some other types of economics, but I'm focusing on where we're going because this is happening right now. So some of these new funds that I was describing to you that are doing the real world asset lending, they are paying a protocol fee to the protocol. Protocol pays its expenses. It has governance. It is a decentralized autonomous organization, or a DAO, which is a new form of organization, which, lawmakers all around the world are going to have to figure out how they're going to regulate and interact with these. But it's a very open, almost kind of like communal style of ownership of this, or governorship of this protocol. And the owners of the True Token are entitled to any economic returns that happen above paying for the DAO expenses. So theoretically, at some point, once we have a surplus of protocol fees after we pay the expenses for the DAO, we could either go out into the marketplace and buy in True, or we could distribute the excess funds in the form of stablecoins to the holders of True. And True holders get to vote on what happens. They get to vote on who are the board members of the DAO. Big, important kind of overall meta issues or major structural changes will be voted on. We don't expect the individual voters on True to vote on individual credit decisions or things like that, because that's why the experts, the portfolio managers are coming on there. And so, at one point we had a vision and we wondered whether we could have them all the way down at the micro level. And some of our earliest funds, which are still out there and existent, we allowed the True holders to decide whether they wanted to stake their True against that to be a first loss in case there is a loss. We've had no losses today to the True holders, but they are able to stake their True in order to earn a little bit of a share of the interest, in effect providing credit insurance against a loss. But we think the long-term vision of that is for the True coin to be, again, this participant in the protocol fees after paying for expenses. And that's what we think is going to drive the value. Right now, we charge, tens of basis points for the protocol fees in order for the portfolio managers to utilize the software to run their portfolio. Over time, as the business scales, our goal is for that to go down to very, very, very small, single basis points, and maybe longer term when we get, to way down the road into the trillions, into, fractions of basis points, because it will be such a large marketplace. You don't need to charge very much. So that people are enjoying that efficiency without very much of a drag in terms of the expenses. That's down the road. So that's the TrueFi side. Let me pause there and see if you want to redirect me in terms of talking about other parts. But I realize it's complicated, and I hope I elucidated and did not confuse in giving that description.
Yes, I think I sort of have something that the audience doesn't. It's because I've studied this before, and we did a pre-interview. So I just want to make sure that people get it. So people own True, which is the utility token, and they essentially get to vote what the company does. It's essentially like, voting. If you have a share of Coca-Cola, you can vote on what it does. I mean, often people don't vote at all. If it's passively held, it's voted in the way that the directors want. So that's the governance token. That is a floating. It's not a stablecoin. It's a floating thing that's sort of quoted
trades in the marketplace, so, goes up and down.
Right,
it's based on people's views.
Almost every other crypto asset, that is down. Somewhere 80 to 90%.
Materially down. Yes.
Yes. So that is materially down. So when you said that holders of True have not been subject to losses, I think you were referring to that there have been no defaults.
The ones who staked, exactly. Exactly. Yeah. But if somebody bought True, 6 months ago, just like a lot of other crypto-related assets or other tokens similar to ours, yes, they've definitely lost money, which is obviously unfortunate. It's again, back to the analogy of the dot-com boom. There were a lot of early internet businesses that got ahead of themselves in terms of valuation. And obviously, we think long-term, True has huge promise, and we think it's a very interesting protocol that will, over time, prove out its economic model. But it is definitely down, and all of us at the company are holders of True, and we're right there with all of our independent True holders, licking our wounds in that regard.
Mm-hmm. But tell us about the credit losses, because you said that your marketplace has never had a default. And I believe you, but I also know that there's some in the TradFi examples. For example, a AAA security never goes bad, because before it goes bad, it's downgraded to AA and then single A, and then once it's triple C, then it defaults, right? So when you say it's never defaulted, what exactly do you mean?
Great question. So we've not yet, in our founding strategies, I mentioned the 4 stablecoins, which are each are depositable into 4 different of our founding pools. We've not had a default in any of the loans that we've made, and we've made $1.7 billion of loans since we started lending in November of 2020. And we've had an incredible number of repayments, because our total loans outstanding today is probably somewhere in the 300 million range. I didn't click on my screen this morning to see where it is. We've had some repayments in the last week. And so we have a large amount outstanding. We've made a lot of loans. Across all of that activity, we've had absolutely, no failures in the software. No money has been lost from it going to the wrong place. And we've had no defaults. We don't expect we're going to have no defaults. And also, we have done some negotiations behind the scenes, because that happens in credit markets, where you talk to your borrowers and you say, hey, we want you to do this. Or they say, hey, can you modify these terms? We have done some behind the scenes private restructurings with people, but we've not had an official default. We will have defaults. There is no such thing as defaultless lending. That's not really a business. That's like, lending somebody their own money, and they can pay it back to you because it was their money. That's not a real business. But we have been very, very fortunate. And I would say we made our own fortune because we brought a serious credit diligence to this. And we took a very traditional approach. We hired folks with extraordinary experience in traditional credit lending, and they brought a traditional credit lens to this. And there were a lot of people that applied to borrow money from us that we looked at it and we asked them for information, and either they didn't give us the information we wanted, or we didn't like what we saw and we turned them down and we didn't lend to them. And so that part of that, why we think we've fared better than some of the CeFi lenders that have had run into trouble, et cetera, is because they either made really bad decisions on a credit basis, I don't know what else to call it, or they were taking too much risk for the wrong underlying return, and they were taking effectively equity risk for fixed income or credit returns. And they also had the classic mismatch of their investors wanted their funds on a short-term basis able to be repaid, and some of these loans were being made on a longer-term basis, and they had the classic run on the bank, and the funds weren't there. But we've avoided that so far because we don't have this same issue. We have put in place mechanisms in our funds so that people realize that when there's liquidity, they can withdraw. But if the funds are loaned out, then they can't get it at those times. But no one's had any trouble withdrawing from any of our funds. When the loans come back in and they get repaid, the liquidity flows in, and investors take money out and put money in. So that's how we've avoided it so far. I don't think there's any really other magic to it other than just blocking and tackling credit. And that's the distinction between us and some of the CeFi lenders that you've mentioned that have gotten in trouble.
Yes. And so as you said, you had 4 pools, and some of those pools invest in only DeFi and CeFi, not real world stuff. Some of those pools invest only in real world, like the Mexican payments company, and some of them invest in both, right? What's the sort of
4 founding pools do just invest into the crypto markets, doing uncollateralized working capital loans to market makers and to delta neutral hedge funds. So that's what those 4 do. We have a handful of other funds that are doing the real world, some of which we're the manager of. So the fintech business in Mexico, we in our internal asset management group, we are the fund manager of that. Then we have these other strategies that are outside of ours. We have a strategy with a group called Chorus, who's a great partner of ours. They're a portfolio manager who's currently running a strategy to lend to fintech businesses in the developing world. Again, that's going into real world applications and investments, and that's an external portfolio manager. That's not us. That's a manager who's using the protocol and using the underlying blockchain software. But again, our 4 founding strategies that I mentioned are all in the native crypto markets where most of our lending has happened. The real world assets business is still a small single-digit millions business on its way to growth.
Mm-hmm. So in the traditional finance markets, the maturity is how long the lender has borrowed the money, when the money is due back from the person who has borrowed. And that can be 3 months, it can be 6 months, it can be a year, it can be a fixed rate, it can be a floating rate plus a LIBOR or a SOFR or other benchmark, which is heavily influenced by the Federal Reserve. What are sort of the terms that you're making? Let's stick to the non-real world, uncollateralized lending that you're lending to market neutral hedge funds and delta neutral funds. What does sort of the terms look like? And if you see something that they did on their chain that you really don't like, are you able to pull the money immediately? Is it sort of a flash liquidation, or do you have to really work those phones to get the money back like over the next week? Sort of, what does it look like?
Great question. So the lending into those, I'll mention a couple of names of the borrowers who've been big borrowers with us, because these are names in the crypto world that are very well known. Alameda, Wintermute are 2 of the big names that we've loaned a lot of money to. Alameda, of course, is the hedge fund that's affiliated with and owned by Sam Bankman-Fried of FTX fame.
Yes.
And so our loans to them are anywhere from 30, 60, 90, and as long as 180 days. These loans are made to them on a coupon that's on a fixed basis across that relatively short-term loan basis. It tends to be in the high single digits. When we first started with some of these borrowers, they were in the low double digits. But over time, as they've proven their ability to to repay, and they have a good repayment history. And also, as they've increased the visibility we have into their finances and sharing with us their financial strategies and statements and are doing analysis on that, their rates have come down. But to your question about, can we lend the money to them? And if we don't like what they've done, if we lend money to them on a 180-day basis, we don't get it back until 180 days, and we can't recall that capital. So they, for working capital purposes, can plan on that, and they know what their cost of funds of that is. And obviously, the activity they're doing as market makers or in this matched trading strategy where they're trying to scrape inefficiencies out of the marketplace. But try and do that in a way where they're not taking risk. They're making better returns than what we're charging them. Obviously, they wouldn't do that. And this working capital is a substitute for them putting in additional equity capital. And equity capital gets 100% of return of the profits. And so they'd obviously rather use our capital than that. But no, we can't bring it back in early. But this has become a standard. We're not the only ones doing this. We were one of the pioneers in doing this uncollateralized lending. In fact, I think we were the first to do it on a blockchain, open, transparent way. But it's worked really well so far. And again, the beauty of our protocol is you can go in and you can look at every loan that's ever been made to Alameda. You can see when they took it out, what the rate was, and when they repaid it. And you can see currently which ones are outstanding to them. Et cetera. What we don't share is the credit work we're doing behind the scenes. And again, people say, well, what does that look like? Well, go to any of your favorite alternative lenders out there. It would look just like the analysis that they're doing. And people are sharing that information with us. The borrowers are sharing that with us on a confidential basis. We think there will be a lot of innovation about how credit information gets shared and done in the future. A lot of people are working, including in a very whiz-bang technology area called zero knowledge proofs and ways to share information so that people can know that the credit assessment has been done, but not necessarily know one, who the borrower is or what that information was that was shared by that borrower, and to do it in a way that the credit work is done off chain, but people can be assured that fundamental credit work has been done and that their money is safe if they deploy it into that account. But that's what we're currently doing, and it's worked very, very well. And this is this proof of concept that we think has made it clear and compelling that this is an area that's going to grow.
Yeah. That's fascinating. Uncollateralized lending. On the face of it, uncollateralized lending it sounds unsafe. And in a vacuum, you'd rather be collateralized than under collateralized. But the question is, would you rather lend to a highly risky business on a collateralized basis or a blue chip firm on an uncollateralized basis?
I can argue both sides of that. We've chosen to focus on an area that is fundamentally difficult, which is fundamental uncollateralized or under collateralized work. Doesn't mean there's not assets in the mix there, but we're not counting on our ability to liquidate those assets to get repaid. We're counting on the borrower having a productive underlying business being able to repay us. That is just the hugest part. That's the mass majority of that $7 trillion we talked about in terms of global corporate lending. That area is growing very, very quickly. It's an area that investors up and down the scale, institutional investors already have great access to that area. They're the ones who are able to go to the very sophisticated, large alternative credit players. Name some of my favorites like Blackstone Credit or Apollo or folks like that. Those institutions have access to that. Even high net worth individuals have access to that if they go through some of these sophisticated asset management platforms, et cetera. Making that more broadly available to maybe accredited investors who aren't necessarily ultra high net worth investors. That's part of what is the thesis of what we think this is doing, because more and more people want access to that. They don't want to just go to their favorite mutual fund complex, Fidelity, Vanguard, Schwab, whoever it is, and just invest in the intermediate bond fund. That may be a part of their asset allocation, but some of them want to take a little bit more risk and get paid more yield and put that into the mix of their portfolio. And that's what we're trying to provide. And that's what we think, is going to be compelling as a marketplace. Eventually, do we think that there will be people managing, good old intermediate investment grade corporate bond funds on the TrueFi marketplace? Yes, we do. Look, that's a pretty efficient marketplace right now. If you look at how little, Vanguard and Fidelity charge for that type of fund, it's very low basis points. And so that's a pretty efficient market. We need our marketplace to get a lot bigger and a lot more efficient before we think we're going to be competitive with that. That's why we're focusing on the higher octane, more risk markets that are not as well served and that have a more of an opportunity.
Bill, let's say that I was the founder of a crypto platform that did very well during the bull market, but it had some liquidity issues and ultimately declared Chapter 11. And folks to whom I owe money, my firm owes money, they are not doing so well, and that includes the depositors who are not FDIC insured. Let's say there's lender A that lent to me and they made a mistake because they didn't do rigorous credit analysis. And then there's your firm that you didn't lend to me. What are the red flags that you would have said about my firm that said, you know what, Jack's a nice guy, but we're going to pass on this?
That's a great question. It fundamentally starts at our credit diligence that we go through. We don't have a formula for what we're looking for in a credit situation. So if we would come to you, Jack, we would look at your business, have you explain our business, and then we would give you a diligence list of what we needed from you. And so the initial response is, and this happened during the bull market that was happening 6-9 months ago. A lot of people were trying to break into the business of doing this kind of uncollateralized lending on chain. Some of them are into this marketplace. Some of them are doing it in a CeFi sense, and that's some of the folks that you've mentioned before that are struggling, and some of which are in bankruptcy right now. And some of them were on-chain protocols. But there was so much competition to put money to work that some people were willing to do that without looking for all that information. So our biggest red flag would be someone would say, well, we're not willing to provide that. And even scarier, we don't have that. And so that would be the most likely reason that we would say, you know what, this isn't a good fit. When you have that, or when you are willing to share that, let's talk about that, because we need a certain baseline of information based on who you are to do that. So that's the single biggest red flag. And that is still going on in the marketplace, which is amazing to us. But I don't blame the borrowers. If somebody will give you money without putting you through the ringer and making you do a certain level of diligence, it's not your fault for taking the money. It's somebody's fault for giving it to you.
So uncollateralized lending, you have to do rigorous analysis on your borrower. Whereas in, over the Aave platform, if you're lending against Uniswap, as soon as Uniswap goes below $5, it's liquidated.
Whereas they don't care who the borrower is. That's the beauty of it. And again, we think this is a genius model. We think that is a genius model. The Aave and compounds of the world are fantastic. We think that will migrate over into traditional margin lending, where eventually, let's assume that all stock equities are tokenized and trading on the blockchain. We care deeply who these people are. We call it credit investing, but it's also reputation and who they are. And so that's the other red flag is we get into these diligence sessions and we're making a judgment on who these people are. We look into their backgrounds. We see what they've done. We see what their expertise is, and we're making a credit bet on them. And so the other red flags are if we look at people and there's things in their background that we don't understand or that we think are red flags for reputational or character risk. That's another reason for us to say, this is not a good fit, and we wish you luck in finding capital somewhere else.
So that's the risk of the left tail risk that you really don't want, where you lend to someone and they don't pay you back. What about, I guess it's called the right tail risk, where the market realizes that, the person you're lending to, they're good for it, and then the yield goes way down and your opportunity sort of evaporates. Like, Alameda, like I know that Alameda is kind of like the JP Morgan of the crypto space. So if I know it, everyone knows it. So what's the risk of, them saying, actually, we want to pay you 4%?
So that risk is real, and we think that's healthy, and that's okay, because that means that the underlying risk is being recognized by the marketplace, and the borrower is able to access capital at a lower rate. And so that's good for the lenders, investors who are showing up on our marketplace. And we want to have that whole continuum of risk. And so if Alameda gets to be a better and better credit, which they are all the time, and their cost of borrowing goes down, then there will be funds and portfolio managers on the TrueFi marketplace who say, we're going for high quality market making lending, and expect our coupons are going to look in that sort of 4 to 5% range. But for more emerging managers who aren't the Alamedas of the world, we're going to there's other funds, or maybe within that fund they're willing to take more risk. So we view that as just a natural and healthy evolution. And again, obviously it's dynamic. And so over time, some people may become better credits, and then their fortunes may change and they become riskier credits. And we think that that's what will make our marketplace work, which is the different managers who have different insights on that. The ones that succeed will come, and they'll be good arbiters of that credit risk and good investors behind that.
Okay. And so let's say someone who borrows from you, they pay 9%. What does the people staking their True or investing in the firm, the portfolio managers, what do they get? And does TrustToken, do you guys get a basis point spread, a percentage of the percentage, a flat out fee? How does it work?
So here's the way the founding funds are set up, and new funds are being set up slightly differently. The founding funds, 100% of the interest goes to the investors with one caveat, which is true holders who want to stake and be the first loss in that, they get 10% of that interest. So let's make a simple example. So somebody makes a $100 loan, it's a 10% interest rate, and true stakers then come in and put up $10 worth of true, so that the first $10 that get lost, if there's a loss in that fund, they're going to take that first loss. They get 10% of the interest. So in my simple example, $100 at 10%, there's $10 of interest. $1 of that goes to the true stakers, and $9 of that goes to the lenders into that fund. So that's how the founding funds were set up. There's no asset management fee. We're not charging an asset management fee for that because this was our proof of concept. Going forward, and on our new funds that we're setting up, or new funds that independent portfolio managers are coming to set up, there are two levels of fees. There's the asset management fee. So that's the manager saying, I'm really good at this credit and I'm worth 1% of whatever yield I create here. I'm going to charge 1% on the assets that you invest into my fund for me to manage it. And there's the protocol fee on top of that, because instead of my building out all the traditional infrastructure of running a fund, having asset management software, having bank accounts that move the money around, et cetera, and all the layers that they need to have around that, instead, I'm going to use the TrueFi marketplace, and that's going to charge a certain number of basis points. So most of the new funds that we're doing right now are being charged 50 basis points to use the TrueFi software. So back to my simple example. So someone would pay 1% to the manager and then 50 basis points, so 1.5%. So if the overall target yield of the fund is 10%, well, then the net yield would be about 8.5% after you pay the manager and you pay the protocol fee. And so really good managers who have really good returns, they'll be able to charge higher fees and garner more assets. And also, over time, we expect that the protocol fees will come down as the overall marketplace grows. Right now, we're pricing it around 50 basis points because that's a good place to start. We expect over time to be competitive, and particularly we were talking about some of those lower risk strategies. You can't pay 50 basis points on a U.S. Treasury fund. Well, we don't have a U.S. Treasury fund today, but if U.S. Treasuries are yielding 2-3%, depending on how far out on the curve you go, 50 basis points of a protocol fee, that would swamp your returns. That wouldn't be competitive. So someday when we have U.S. Treasury funds on there, those would probably pay, 2-3 basis points or whatever, which again is equivalent to what you would pay to be in a U.S. Treasury mutual fund, in terms of overall expenses, against that yield. So anyway, hopefully that outlines kind of how the economics would work and what the investor or lender would pay when they show up on the marketplace.
It does. Thank you. So there's some who pay no fees and some who are paying the 50%, 50 basis points plus.
And those no fees things, we're going to sunset that. That was, call that sort of, early days. We're discounting the fees all the way to zero for the asset management because we wanted people to come and see that and experiment that. They've obviously seen that we've generated great returns with very low credit losses, so far zero. And so hopefully they won't be surprised when we say, now we're going to charge for it. That was the early days. So, think of it like, in the early days, you got free shipping in e-commerce when that first came on. And then eventually, you had to pay for shipping because they were no longer giving sort of discounts on that.
Right. Okay. And then the folks who are staking their True and they pay the first in credit losses. What is the definition of a credit loss? Obviously, a default is a credit loss, but you've never had defaults. What if, is it marking something down from $100 a loan from $100 to $90? Is that a loan? How do you decide to mark it down? In traditional finance, there's tons of examples of things that were priced at 100 that ultimately went to zero. So how do you go about sort of marking stuff down? And then also, if the longest that you're lending in some cases is 180 days.
Yep.
How does that happen? And have there been losses?
There have not yet. And again, I know I'm sounding like a broken record. I keep saying this. There will be losses. There is no such thing as a lending business without credit losses. But here's what would happen is if one of our borrowers came back and said, I owe you, I'm using silly numbers, $100, but I can't pay all that back. I'm going to only pay you 95 back. So what would happen would be if that loss on that loan, that first, that $5 loss would be in the founding funds. This is not how all funds are going to be working going forward. Just in our founding funds, the folks who stake their True, they would be the first loss against that.
But that's never happened, you're saying?
That's never happened. And so far, those folks that are staking True have been earning that interest and just getting pure interest for providing credit insurance that hasn't been called on. But insurance that hasn't been called on doesn't mean the insurance was mispriced. It just means the event hasn't happened yet.
Right. Well, that's interesting because I've seen a lot of other folks struggle because it's been a very, as crypto prices have fallen and as there have been, I guess, net outflows instead of net inflows, that has been a hostile environment for investors, not only who are buying the equity of the tokens, but people who are lending, who are doing the lending. So, how is it that you've never had a loss? And also, are you saying that there's never been anything? There's never been anything other than the follow scenario, in that they pay you back. Like they've never been paid early or nothing.
Not so far. Well, we had one loan actually end early, and thanks for calling that out because. We were lending to a borrower who was part of the Three Arrows family. And as soon as Three Arrows hit the news, and this is, I can talk about this because this is public, we're an active credit manager for the funds that we run. And any portfolio manager we bring on, we would assume they would do the same, even if they were independent of us. And so our head of credit and head of lending immediately went into action and arranged for that loan to be repaid early. And so it was an early repayment because we just said, look, we don't know what's going to happen with you all. And again, they were not Three Arrows. They were a fund affiliated with Three Arrows. And they were on our user interface. You can see that we had a loan that was guaranteed by Three Arrows and it was repaid early. That's called good credit management. We went in and said, let's not wait to see what happens. Let's deal with this now. And so again, no losses on that. That loan was, repaid, in full back to the fund. So there was no loss in that instance. That's why we're able to say there's no defaults. That doesn't mean we didn't take real proactive action in order to head that off. And we're probably doing that behind the scenes. Not probably, we are doing that behind the scenes. We're constantly monitoring our loans. And so while someone isn't obligated to pay us back early, that doesn't mean we can't go and have a negotiation with them and say, hey, does it make sense for you to repay early? Because, you want to keep your borrowing reputation intact. And so that affiliate fund that was borrowing from us, their reputation is intact. Their parent company, Three Arrows, is going through issues, but those folks did, we think, a very smart thing. They said, we have the liquidity. We're happy to enter into that transaction with you. And so they kept their borrowing reputation and their credit intact by doing that. We think that was a smart move on their part. We think it was a smart move on our part.
Mm. And are the loans that you make, do they have the same legal binding power as a mortgage or a corporate credit line? It's first lien. If someone does default on you, and you go and you walk into the courtroom, is the judge going to be like, what's this crypto thing?
Great question. So yes, we are lending under the same types of legal agreements that all loans are made under, whether you talked about a mortgage, but we're not directly. We have a portfolio manager who's running a mortgage related strategy, and they're using traditional mortgage documents. For our lending, there is a master lending agreement, which is a traditional legal lending agreement. And if somebody defaults, we will go into court. And it doesn't matter. There are actual entities underlying these, and there's a lot of complexity about what the entities are. They're actually the ones signing these agreements. I don't think that's useful for our discussion here today. But that entity goes in, and they will have full and true standing in that court. And no, the judge won't say, "Oh no, you guys were from that gambling world of crypto. You don't have any standing." They will say, "I recognize you, and we have true legal standing." So it's in that sense. If there is a deficiency claim, meaning somebody's defaulted and we have to go pursue it, we'll have the same standing as somebody who is just a traditional lender.
Okay, and then I know that uncollateralized means there's no collateral, but is there sort of a hierarchy? Like, are you in the middle or the bottom of the capital stack? Where obviously you're above someone who owns equity in a company, you're above them, but who are you below? Are there people who are like the first lien?
Depends on the lending. So yeah, so sometimes we come in and that's part of the credit analysis we do. We look at the liability stack and we see, is there anybody secured above us? Where are we? Are we just above the equity? And then we craft the legal agreement to conform with where we're comfortable being in that risk. And so sometimes we say, we need to be pari passu with everyone else. So if we're an unsecured lender, there's nobody who's secured above us. And so that all the assets are going to be carved up with us as a class with all the unsecured lenders. And so, again, it's case by case, but we're very careful about that lending agreement to make sure we know where we stand so that we feel like we're pricing our loan correctly based on who's ahead of us and who's behind us.
Mm-hmm. Do you think about, I don't know what to call it, maybe correlation risk? So for example, an NFT company, a company whose, their business is lending money against people's NFTs, that's probably going to do pretty good in the bull market, probably pretty good from January 2021 to November 2021. But I can imagine that, I'm just throwing this out, I'm not saying any company, but that type of business is one that will struggle as the prices of tokens go down. So do you sort of view it as, if you're lending to an oil company, you want to have them hedged or something like that?
Yes, we do. And we think about correlation risk both in each individual loan that we're making out of our credit strategies. Obviously, we rely on, if it's an independent portfolio manager running their strategy, we're going to rely on them to be thinking about that. And we obviously, onboard and diligence those folks, but at the end of the day, they're their own credit experts and they're going to stand or fall on their own reputation. But when we're managing the underlying credit, we do think about that. And we think about, is there risk in terms of the overall levels of the marketplace? We also think about it in terms of whether are we lending to somebody who's effectively doing the same trade or same activity as everybody else. And so that even places where we're not loaned into, there's too much credit extending into this space. That's kind of a reference back to the, and again, students of financial history will remember the long-term credit management meltdown in the late 90s that happened, where it turned out that they, who were supposed to be the smartest investors, ever assembled, a bunch of Nobel Prize guys, they were doing strategies just like everybody else was all around Wall Street. And so when the market started to crash, everybody, tried to exit and get liquidity at the same time. We think about that all the time. And a part of why some of our growth may have been slower at times very deliberately than some of our competitors was because we said, we got to be careful here because if there is a downturn, there's going to be everybody heading for the exits at the same time. And so again, individual correlation or the asset correlation to the overall markets, we think a lot about that. Our founding strategies were very asset agnostic because the way people were making money that we were lending to was in making a market. And that's why they're called market makers, obviously. And so they weren't making money whether the asset went up or down. They were making money from making the market between the buyer and the seller and earning a spread on that. And so that's a volume and volatility based business, which again, can be subject to market conditions. But we were comfortable that these market makers were doing it in a way that they weren't taking a view either way. They weren't long and they weren't short. They were simply providing just enough inventory for them to make orderly market flow, and that's a good business. And particularly a good business in a new market like crypto, where the underlying trading was inefficient. Over time, we think some of those returns will get competed or arbitraged out of the market. But right now, that's still a good business, and that's why you see us still lending into that space.
Right. Market neutral means they are neutral on the delta. They don't make money if it goes up or down, but it is dependent. Their business is affected by, how many people are trading, are volumes high, is volatility high or low. So there are risks. There are things that are better than others. It's just not the direction of any underlying token. Bill, so if I were to look at let's say year to date total return index for an ultra short income fund, is essentially flat on the year for TradFi. I pulled up an ETF. What would the returns look like for TrueFi? And do you think those returns are sustainable?
Great question. So they would look like over the life of our doing these funds, and you can look at this and calculate this. It's high single digits, maybe approaching around 10%. And the reason for that is because if you look at the market cycle we've been through, those were fantastic years, exactly the point you were talking about in your last statement. There was a lot of volume. There was a lot of people making a market, and there was a lot of demand for capital. And so that's why we made those returns. long term in this specific area, that shouldn't exist because the trading should get more efficient. There should be more competition for making that market over time, and those spreads that those people that are able to earn in doing that riskless market facilitation, that should come down. And as a result, they shouldn't be able to pay us, high single digit, low double digit cost on the interest. So I don't necessarily think that's going to be around. Now, over times of volatility and times of market dislocation, maybe those market making spreads do expand back out and that demand will come back. So we think that's an important market. We think it's a market that gets efficient over time. So I don't think you should expect to see those returns. But again, as the risk comes down, so will the returns. That what we hope and what we are working on in our business development areas is finding new managers that are finding new and interesting emerging areas to deploy capital into, like the fintech business in Mexico, like that unique mortgage structure, like the folks at Caras who are doing the lending into the emerging markets in fintech businesses and emerging markets, somewhat similar to what's going on in Mexico. We think those will be interesting areas. They're not risk free. I mean, these are new credit and balance sheet oriented businesses that have higher risk because they're inherently playing into markets that banks have not figured out how to efficiently serve. But that's where people are going to find the interesting returns. So again, but on our founding markets, back to your underlying question, we think those returns over time will go down because the risk is going to go down and the market's going to mature.
I know you don't want to not name names. I'm not going to name names, but the companies that are no longer here that have gone through insolvency, what do you think are the practices or that they did? In other words, why do you think they got themselves in the situation? And why are you here? Why is TrustToken still here, still doing a podcast? Was it those companies? Did they hire too fast? Did they not keep their costs under control? Did they want to grow too fast? Did they not secure a stable source of funding? Perhaps it's all of those, but I just love if you could share your thoughts on that.
You bet. Well, so the one I want to hit on first is something you just talked about. We think a lot of them were too focused on growth, where in effect they were catering to their equity holders who wanted them to grow their assets under management very, very quickly. And how do you do that? You take more and more risk. And so in effect, their lenders, their investors who were providing the capital that they were going to then loan out, they were being subordinated, if you will, to the desires of the equity holders of those businesses. So that's one of the fundamental things that happened there. The desire for growth outstripped the prudence of what's a safe way to grow quickly. The other thing that I think is different about us and them is that if you look at it, the vast majority of the businesses that have failed were centralized businesses. They weren't using the blockchain for its transparency and its openness to run their lending strategy out in the open where everyone could see it. They were running huge books, in some cases, tens of billions of dollars of lending, but you didn't know what they were doing. And so that was them taking advantage of this very interesting high growth market that was happening, but not taking advantage of the best part of the technology, which is to create trust through transparency and immutable record of what's happened so that nobody can ever change that and you'll know exactly what happened. And so I think that's the other reason that we would point to is that the protocols that have survived and done well, and some of these are our competitors and we think very highly of them and we enjoy competing with them every day. People like Maple and Goldfinch and Centrifuge, we're all the ones who are still out there because you could see exactly what we were doing. And you couldn't see what those centralized finance folks were doing. And they were trying to grow to make money for their equity holders. And they were raising tons of money and there was lots of venture capital. And they made bad choices. They also ran into the other thing that you talked about, which is the classic, duration mismatch, which is they were promising their investors could have their money back on a short-term basis. But they were making loans on a long-term basis. And that's just what happened in the financial crisis before. And so in a lot of ways, they just replicated what happened in the great financial crisis, but they were doing it in the underlying crypto markets. That's my best description I can give of it. I mean, lessons like this, bubbles, excitement, irrational exuberance, to use an old term from the dot-com bust. These are things that, unfortunately, these are cycles that repeat themselves, and it comes back, and people will start saying it's different this time. And unfortunately, in this instance, it was not different.
Yes, it was not. Bill, how do you see the space evolving? I know earlier you said that you see the future as blockchains as people not having to trust institutions. There was a quite outspoken founder of a company who said, banks, you can't trust the banks. That person's the people who put money in them, that they have to go to bankruptcy court, again, because all assets in crypto, or almost every asset in crypto, is not FDIC insured. So the word deposit may not be appropriate. It's more like lenders or investors. How do you see the space moving forward, given that there have been so many folks, who have lost money or at the very least have had their money tied up because, they did trust these CeFi companies. Obviously, if it works, if what you say is true about TrustToken, that's great, but you're only one company in a sea of companies that, there are many companies that have suffered. So how do you see the space sort of moving forward?
Great question. So look, we're all going to pay for the sins of others. And so it's absolutely true that a lot of people are looking at this and saying, gosh, these guys were not telling us the truth. They weren't doing what they said they were doing. And because we're next to and adjacent to them, we're going to pay the price for that. In the same way that the .com bust blew out a ton of people who didn't really have a business model. They literally just attached, .com to their business. And that's similar to how a lot of the people that failed were saying, oh, I'm crypto. But they weren't really using the power of the underlying technology. So to your question, what do we think is going to happen? We think there's going to be a rebuilding of trust and a rebuilding of understanding the differences between what did go wrong and why did it go wrong? And again, those of us who are using the technology in a transparent way. And so we're working really hard to make the distinction. That's why we're saying, we're not a crypto company. We started our strategy by lending into crypto market makers, et cetera. We're a blockchain company. We're using this technology to build something that is better than the traditional rails that exist in finance right now today. And so we think it's going to be a while before the dust settles and people see how these bankruptcies work out, and that they also are able to differentiate what we're doing from what others were doing. And we're going to keep building. We're in the background. This is obviously the part that no one sees. We're working on new iterations and new power of our technology. We know it's something that the traditional finance world is interested in. How do we know that? We're talking to all the major players. I won't mention any of my favorite names. Think of your favorite investment banks and major money center banks. They're all experimenting and looking at this too, because they want to try and build their own private walled garden version of what we're trying to do, which is a debt marketplace. But what we believe it should be is one giant open marketplace. And again, we don't think there's going to be just one of them. We think this is not a winner take all market. We think there will be a bunch of players that can participate in this. But we think slowly investors will look at it and say, this is different. That's not what those centralized folks were doing, that were not telling us exactly what they were doing and that were making poor credit choices and taking too much risk. And this is just a place where good managers can come and build their business and be a portfolio manager. I'm not sure when it's going to happen, but the big sort of inflection point to look for is when a major existing player says, you know what, I'm opening my fund on the TrueFi marketplace. So somebody who's got a huge TradFi reputation. I can't tell you when that's going to happen. I can just tell you we believe that will happen because they'll look at our software and they'll say, yeah, that's much more efficient than how I'm currently running my business. And that transparency and that 24/7 transactability, I want that. That's when you'll see the real inflection point. That won't happen tomorrow. That may not happen in the next few months, but that we believe is what's going to happen. That's where we see the business going. There's a chance that you'll see some privately built platforms that try to do this. We still think the open, public, not owned by any one rent-sinking central party is the best way to do that. The analogy we think of that is sort of like some of these open financial market utilities. If you think about the DTC, the Depository Trust Corporation, which is the consortium owned by major brokerage houses to exchange and transfer securities amongst themselves from a custody basis. That's kind of how what we think TrueFi is in terms of a marketplace for people to manage and exchange credit on the marketplace. And so that's where we think it's going to go. And we've got a lot of hard work to do and a lot of building, and we've got a lot of explaining to make people understand, because when there's a train wreck, everybody says, oh, all trains are not safe. And that's not the right conclusion to take. And I appreciate you having us on here as a company to tell our story, because through great podcasts like yours, this is the place where we're going to have TradFi folks and early adopters come and look at this and say, oh, that is different. Maybe I should give that a look.
It's been my pleasure, Bill. Thank you for coming on. My final question, I do have a macro podcast, so I have to ask you a macro question, is how do you think about the Federal Reserve, specifically the fact that interest rates are now higher? You're a chief investment officer of your firm, and you have a storied career in traditional finance. That high single-digit returns, those are impressive regardless of whether 0% or 3%. But when interest rates are at 3%, maybe folks they still want to get into that 9%, the high single digits, but they're like, hey, the Treasury's the Fed is giving me 3%.
Okay, so great question. I appreciate you asking me for my crystal ball view, and my crystal ball is as hazy as anyone else's, but that won't stop me from talking about it. So what we think is going to happen is that we think there will be an expansion of the rate and an expansion of spreads over Treasuries. Obviously, our marketplace somewhat was dislocated from references to traditional benchmarks like the U.S. Treasury, because there was a lot of capital flowing into it. And we think that compressed spreads artificially. We think that as the Fed continues to raise rates, which is obviously what the market expects them to do, there will be a continued widening out. And so those high single-digit returns will have to your point, they'll have to expand into low double-digit returns, because people will just say, I'm taking more risk. I need to make sure I'm getting paid for it. And so that's what we believe is going to happen. That partially depends on the supply and demand in the particular markets of whoever is managing a fund on our marketplace, and in our founding strategies for the ones going to the crypto markets, that will depend on what the supply and demand of the capital is. So if it doesn't expand as I just predicted, that's because more capital was there and people were willing to take a little bit less payment for what is obviously more risk, and compared to where they could have gone to the risk-free return before. I don't know if that satisfied your macro question there, but that's my bet is Fed keeps expanding, rates will have to expand out, otherwise risk is being mispriced.
Right. And that will not just crypto spreads, but high yield spreads and TradFi, investment grade creds. Well, Bill, thank you so much for coming on. It's been an absolute pleasure.
Thank you so much for having me, Jack. I really enjoyed it.
There is something that you need to be doing right now, and that is reading the Blockworks daily newsletter. For top market insights and the latest in crypto news, you have to subscribe to the Blockworks daily newsletter, and you can do so by clicking on the link in the description to this video, or by visiting blockworks.co/newsletter.